Welcome to the deep dive. We're your shortcut, really, to getting well-informed without drowning in information. We take all the research, the articles, the data, pull out what really matters, and hopefully give you those aha moments. Today, we are cracking open CoreWeave Inc.'s Q2 2025 earnings. We've got the official press release mixed in with real-time market data, all structured to make sense. Our mission. Well, it's to unpack CoreWeave's performance, especially that fascinating tension between its absolutely explosive growth and, well, some pretty significant losses. What does this tell us about their strategy in the AI infrastructure race?
Yeah, and looking at CoreWeave is, I think, really crucial right now. It's not just about one company's numbers. It's a snapshot of this whole high-stakes game happening in AI infrastructure. CoreWeave's story gives us real insight into the sheer demand for compute power, the race to build it all out, and frankly, the massive costs involved in scaling that fast. It really shows the price of ambition in this space.
Okay, let's dive in. Now for slide 1, the at-a-glance scorecard. CoreWeave's Q2 results really told, well, two different stories, didn't they? On one side, you've got this huge top-line growth, just blew past what analysts expected. But then the bottom line, the losses were actually wider than people thought. So the specifics, revenue was $1.21 billion. That smashed the consensus estimate, which was around $1.08 billion. But the diluted net loss per share landed at 60 cents negative. That missed the estimate of negative 20 cents. Quite a miss.
It is quite a contrast. And what's really interesting is how the market reacted, or rather didn't react much initially. After the release on August 12th, the stock only dipped about, 1.17% in after hours?
So barely a flicker despite that earnings miss.
Exactly why. Well, it seems like in this AI gold rush environment, investors are laser focused on growth, on grabbing market share. They clearly valued that huge revenue beat, and the strong demand signals way more than the deeper losses, immediate profits. Maybe not the priority right now. And remember, analysts were already a bit cautious going in. Most had it as a hold, citing the high debt and how fast the stock had already run up since the IPO.
Right, so the market's giving them a pass, for now anyway. But let's talk about that gap. Huge revenue growth, 206.8% year over year, which is incredible. Yet the diluted loss per share only improved by 63%. Why such a big difference there? What's happening underneath?
Okay, this gets to the heart of their strategy. Two main things explain that gap. Massive operating deleverage and significant shareholder dilution. First, the costs. To get that revenue growth, their spending just exploded. Total operating expenses jumped from about $318 million to almost $1.2 billion. That's a 275.7% increase year over year.
Wow, so expenses grew even faster than revenue.
Much faster. And that's negative operating leverage right there. It means they're spending more to get each additional dollar revenue. This aggressive spending, mostly on infrastructure and operations, absolutely crushed their GAAP operating margin. It fell from 20% last year to just 2% this quarter.
2%. So they're basically choosing growth over any kind of immediate operational profit. It's a gamble.
A very deliberate one, it seems. And second, dilution. Think of the company's earnings pie. Well, that pie got sliced into way more pieces. The weighted average diluted share count, that's the number used for EPS, went up by over 130%.
130%? How?
Mostly stock-based compensation for employees, attracting talent, plus raising capital. So even if the total net loss improved a bit, spreading it over so many more shares makes the per-share loss look worse or improve less dramatically. And for a tech company like CoreWeave, using lots of stock options, that diluted EPS number is key. It shows the potential impact of all shares, giving you, the shareholder, a more conservative view of your claim on earnings.
Okay, that makes sense. Moving to slide 2, the engine of profitability. So we've got the big revenue, the per-share loss. Now let's look inside the income statement, because there's this really stark difference between the official GAAP results and what management calls their adjusted numbers. GAAP net loss, about negative $290 million. But then they report a positive non-GAAP adjusted EBITDA of over $750 million. That's like a $1 billion swing. How do they get there?
Right, it's about which story they want to emphasize. GAAP generally accepted accounting principles, that's the rule book, everything included, cash and non-cash costs. Non-GAAP measures, those are management's tweaks. They pull out items they argue aren't part of the core day-to-day operations. For CoreWeave, that huge difference, nearly $1.05 billion, it mostly comes down to massive non-cash charges and the cost of financing their huge infrastructure build-out. We can walk through the big ones they add back to get from that GAAP loss to the positive adjusted EBITDA.
Yeah, break it down for us.
Okay, first, the biggest one, depreciation and amortization. They added back almost $560 million. This is non-cash. It's the accounting costs of their servers and data centers aging, basically. Management pulls it out to show performance before accounting for those huge capital investments. Next, interest expense, net. That's nearly $267 million. Real cash cost, right? Paying the piper for all that debt. But EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So, by definition, interest gets added back to focus purely on operations, separate from financing choices.
Got it. So they're saying ignore the cost of building it and financing it for a moment. Just look at how the core service performs.
That's the idea. Then there's stock-based compensation, about $145 million added back, also non-cash. It's the accounting charge for stock options given to employees, often excluded because it's not a direct cash drain now, and it's seen as a strategic cost for talent. Then you have provision for income taxes, nearly $48 million. And other adjustments, about $24.5 million things like costs from acquiring weights and biases, which they see as one-offs, add all those back to the GAAP laws, and boom, you get that positive adjusted EBITDA figure, $753 million. That's their argument for a fundamentally healthy, cash-generating core business.
So it really is two different narratives from the same set of results, both important but painting very different pictures.
Exactly. The GAAP loss. It screams capital intensity, financial risk. Building an AI empire is expensive, and depreciation and interest are real costs. You can't just wish them away. But that non-GAAP view, especially the adjusted EBITDA margin staying strong around 62%, almost flat from last year's 63%, that shows the core service, providing specialized cloud compute, is highly efficient and profitable per unit. That underlying strength is why the market might be giving them that high valuation, focusing on the growth story. Understanding both perspectives is just crucial for you, the listener, to really get what CoreWeave is doing. They're choosing this paper loss to build something huge, fast.
All right, next, slide 3, financial strength and shareholder rewards. We know they're spending big. How are they paying for it all? Well, the balance sheet shows it's heavily reliant on debt, leverage, and that means risk. As of June 30th, total debt was huge, $11.05 billion. That's over $3.6 billion current, $7.4 billion non-current. And that's compared to total stockholders' equity of only $2.66 billion.
Yeah, and that leads us straight to the debt-to-equity ratio. For CoreWeave, it's 4.16.
4.16. So over $4 of debt for every dollar of equity.
That's right. That is very high leverage. It's what's allowed them to pour money into servers and data centers. They spent $2.4 billion on investing activities this quarter alone. But it absolutely magnifies risk. If their business stumbles or if credit markets tighten up, that debt load becomes a serious vulnerability. And we see the direct cost, $267 million in interest expense just for the quarter. That's a big number.
And what about returning cash to shareholders? They paid a small cash dividend, about $2.6 million. It seems odd for a company growing this fast and carrying so much debt. I assume that's not for regular folks holding common stock.
You're spot on. That's almost certainly tied to preferred stock obligations, not a general dividend policy for common shares. And no surprise, zero share repurchases. Why would a company borrowing billions and issuing stock turn around and spend cash buying its own shares back? It just wouldn't make sense.
Right.
What this really highlights is that high-stakes cycle they're in. Borrow money, buy servers, generate revenue, use revenue to pay debt service, repeat. It works. As long as AI demand stays white hot and they can keep accessing capital, it really is, as you said before, a high-wire act.
Okay, finally, slide 4. The road ahead management's outlook and key takeaways. Management's message seems crystal clear. Capture the market, costs are just investments. CEO Michael Intrater said, "We're scaling rapidly, unprecedented demand. Our purpose-built AI cloud platform continues to set new benchmarks." Very bullish. And they backed it up with a monster metric. Revenue backlog hit $30.1 billion. That's committed contracts, real visibility. Plus, they named big customer wins and expansions. OpenAI, BT Group, Cohere, Mistral AI. Serious players.
Absolutely. And pulling all this together, the numbers, the commentary gives us some clear takeaways. First, hyper-growth thesis confirmed. That 200% plus revenue growth, the big beat, that massive $30 billion backlog, it proves CoreWeave is right in the thick of the AI build-out. The growth isn't slowing down, it's locked in. Second, profitability is a deliberate sacrifice. That EPS miss wasn't a failure, it was a choice. The strategy is growth now, profits later. Yes, the GAAP operating margin collapsed to 2% because costs surged 275%, but that stable non-GAAP adjusted EBITDA margin around 62%. It signals the core business works. The unit economics are strong.
So profitability is there, under the surface, waiting for them to dial back the spend.
That seems to be the bet. Third, this is a highly leveraged bet. $11.1 billion in debt. That 4.16 debt-to-equity ratio, it's risky. Everything hinges on continued massive AI demand and open capital markets. It's a big bet on the future. And finally, The market endorses the strategy for now. That tiny stock dip after a big EPS miss, it says investors are buying the growth story. They're prioritizing revenue, backlog, market share over current GAAP profits, and the risky balance sheet. For now, they agree with management's gamble.
So summing it all up, this final narrative for CoreWeave's Q2, it feels like a defining moment. It wasn't just about hitting or missing numbers. It was a loud statement of their strategy. They grabbed incredible revenue growth, riding the AI wave hard. But as we've dissected, it came at a very real, very deliberate cost. Skyrocketing expenses, JAP losses, and a mountain of debt to fuel this land grab.
Right. And the market's reaction, that kind of collective shrug, it suggests that in this AI gold rush, investors are cheering for the companies building the infrastructure, the picks and shovels, even if they're heavily mortgaged. CoreWeave proved they can grow like crazy. The big question now is, how long can they keep funding this massive investment while juggling all that financial risk? That's the story to watch. And for you, the listener, hopefully seeing how we broke this down shows the value of a consistent framework. It lets you get past headlines, see the real drivers, assess the risks, understand the strategy, just build a deeper understanding over time.
And that's our deep dive for today. Financial disclaimer. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While efforts have been made to ensure the accuracy of the information, no guarantee is provided. AI disclaimer. This report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data obtained via real-time web searches. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by the user before making any decisions. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.